Namaste and welcome to Gordan Growth Model of Cost of Capital and a Simple Solution series. We are taking illustration 15 for immediate solution. The first item under that is preference shares redeemable at a premium with the flotation cost. Under redeemable preference shares, we have got the normal formula. In this particular instance, there is a mention of dividend tax. Dividend tax is an outgo for the company. It is not a tax shelter. It is normally used in respect of perpetual preference shares. But in the given case, the shares are specifically redeemable and still there is dividend tax. We may have to consider PD, preference dividend, as preference dividend into 1 plus dividend tax. That modification we will be doing, but on the whole we will be using this formula in the course of solution. The second is equity share selling at rupees 50, paying a dividend of 6. Only price and dividend are given, no growth mentioned. Therefore, we will be using the no growth model for the second part of the problem. Third, equity share as in 2 above, where 50 and 6 are given, where there is a growth rate. The moment growth comes, we have the Gordan's growth model. Therefore, we will be making use of this occasion to understand Gordan growth model in its details. Then in the second one, there is an advancement over Gordan's growth model. Here in the previous case, we were given the growth, whereas there are cases where we have to derive growth based on return on investment expected on retained earnings. This is the case where we have an equity share capital of the company is selling at 120 per share, earnings 20, 50% paid in dividends means 50% is retained. Shareholders expect a constant after-tax rate of 10% on its investment of retained earnings. In a problem like this also, we have to make use of Gordan's growth model and we have to derive G. G, as it is explained in the course of the formula, is equal to B into R. B is 1 minus payout ratio, R is return on investment. It is very simple. But this problem of illustrations 15 is predominantly focusing on Gordan growth model 1 where G is given and another case where G has to be derived based on other inputs. With this background, we will go to the calculation of the first problem. We are talking of 10-year, we have just note 10-year 14% preference dividend. If it is 14 if the face value is 100, because the face value is 100. Redeemable preference shares at a premium of 5 means redemption premium is 5. Flotation cost is 5. Dividend tax is 10%. 10% is 0.1. We take these things, but in our formula, we need RV, redemption value. If face value is 100, redemption premium is 5, then RV is derived as 105. Then, if the issue price is 100 and the flotation cost is 5, means company has spent 5 to receive 100 means net proceeds received is 100 minus 5, 95. With these inputs, we need to proceed to calculate the cost of capital in respect of 14% preference shares. The formula is preference dividend into 1 plus dividend tax plus redemption value minus net proceeds divided by duration n and divided by the whole product divided by redemption value plus net proceeds divided by 2 for average funds deployed. Now taking this equation, we are moving ahead. We post dividend is 14, 1 plus tax, dividend tax is 0.1, that is 10%. NP is 95, redemption with premium of 5 is 105, duration is 10 years. Redemption price, net proceeds divided by 2. This is the equation. Simple. 14 remains 14, 1 plus 0.01, 1 plus 0.1, 1.1 plus 105 minus 95 is 10. 10 divided by 10 is equal to 1. 105 plus 95, 200 divided by 2 is 100. We go ahead. 14 plus into 1.1 is 15.4 plus 1 divided by 100 means 16.4 divided by 100. 16.4% is the cost of capital in respect of additional funds to be raised under 14% preference shares. That is the first answer. Second, an equity share selling of rupees 50 and paying a dividend of 6. Sales price 50, dividend 6. No, and it is indefinite. Continued indefinitely. The equation is very simple. Dividend divided by price. Simple. 6 by 5 means 12 by 100. 12%. This is a simple solution in respect of the equity share. Now third comes the growth based. What it says is the above equity share of 50 rupees and 6 rupees dividend, if dividend are expected to grow at the rate of 5%, there is a growth. The moment there is a growth, Gordan's growth model comes into picture. Gordan's original growth model is given as D1 divided by P0 plus G. D1 is nothing but the current dividend into 1 plus G is the next year's dividend plus growth. This is the final equation which we need to use in respect of Gordan. Though his formula is D1 by P0 plus G, here D1 means D0 into 1 plus G divided by P0 plus G. D is dividend, P is price issued or the current market price. It is simple to work out. D0 into 1 plus G divided by P into 100 plus G. This is the formula as we adopt from here. Do we have the figures? Yes, dividend is 6, price is 50 and growth is 5% means 0.5. 1 plus growth into 100 plus growth percentage. Here we say 0.05 because it has to be added. Otherwise it is 5% only. 5 divided by 100 is 0.05. Here once again we put 5%. Means 6 into 1 plus 0.05, 1.05 into 100 plus 5%. 6 into 1.05 is 6.3 divided by 50 into 100 plus 5%, which is nothing but 12.6. 12.6 plus 5 is equal to 17.6%. This is in respect of number 3. Now comes once again the Gordan's model. We will just note an equity share of a company is selling at 120 rupees. The earnings per share is 20 rupees. of which 50% is paid in dividends. 50% is called payout ratio, 50%. Now, when they give 50% of 20, dividend becomes 50% of 20 is 10. Then dividend is 10. Then the shareholders expect the company to a constant after-tax return of 10%. Rate expected as rate of return is 10%. Now this gives us R. What is B? In the formula, B is equal to 1 plus payout ratio. Payout ratio is 50%, means 0.5. 1 minus 0.5 is equal to 0.5. B is 0.5, that is 50%. R is 10%. The G is equal to B into R, means 50 into 10% is equal to 5%. Therefore, we are deriving G. This example we have taken to understand this problem very specifically. How do we derive G when G is not given but B and R are given? Once G is derived, you are ready to get into the solution. You put the equation. Now put the values. Dividend, we saw it is 10 rupees. Price is 120. Then we have 1 plus G. G we got it here as 5% into 100 plus G. G is once again 5%. Same G we write here for the sake of convenience, 5% and 0.05. From here onwards it is simple. 10 into 1 plus 0.05, 1.05 into 100 plus 5% divided by 120. 10 into 1.05 is 10.5 divided by 120 into 100 plus 5%. This is 10.5 divided by 120 is 8.75% plus 5%, and your cost of capital in respect of equity is 13.75%. That way we have covered the 4 options given, one pertaining to preference shares, then all the other 3 referring to equity shares as such. And that is a thumbs up. And we are through with illustration 15, and we have understood in detail how to work out Gordan's growth model when G is given or when G has to be derived. And this illustration 15 is a wonderful learning example to have a conceptual grasp. Having seen this, this is the time for us to move to another similar problem, but which is slightly different, but it is focusing once again on Gordan's model. Let's have a look at it. This is quite interesting. Aris Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. Means they are raising 10 lakhs for additional finance. It has 2,10,000 in the form of retained earnings available for investment purposes. The following are further details. They have a debt equity ratio, and for availing loan they have got 2 slabs. They say if you take loan up to 1,80,000 you will be charged 10%, and if you take more than 1,80,000, excess over 180 will be charged at 16%. Therefore, our job is first make use of the cheaper loan and then take the balance for 16. Don't do the reverse. First take the cheaper loan for maximum amount possible, 1,80,000. Then go for higher cost loan. Earnings per share is ₹4. Dividend payout is 50% of earning. Expected growth rate in dividend, this is G, 10%. Current market price per share 44. Tax rate 50%. you are supposed to do XYZ. First question says, determine the pattern of rising additional finance. What do we need? We need 10 lakh rupees. They are saying you are given these details. Tell us what is debt, what is equity, what is loan 1, what is loan 2, what is capital, what is earning, retained or retained earning. Simply put, they are giving us some hints for us to find out what is the pattern of raising additional finance. It is just like another crossword in a ratio analysis. Take the first one. Additional finance of rupees 10 lakhs for a meeting. That is the total. This is the total amount we are supposed to raise. As given, it's 100% 10 lakhs. Okay. Then 2,10,000 is in the form of retained earnings. Oh, very good. We are given 2,10,000 as retained earning. Then it says debt is 30% and equity is 70%. That is the mix. Fair enough. 30% is debt. 30% of 10 lakhs is 3 lakhs is debt. And 70% of 10 lakhs automatically becomes equity. That is 7 lakhs. Simple. We know for sure. Equity means equity shares plus retained earnings. Retained earnings are 2,10,000. 7 lakhs is total equity. Difference has got to be equity shares. 7 lakhs minus 2,10,000 is equal to 4,90,000. Similarly, here he says you have to take two types of debts. One debt for 10%, second debt for 16%. Since maximum available is 1,80,000, we first take the cheaper debt to the full extent. Maximum at 10% is 1,80,000. Our total loan is 3 lakhs. We have taken cheaper loan at 1,80,000. Now we will go for balance. 3 lakh minus 1,80,000 is 1,20,000. Now what is he asking us? Determine the pattern of raising the additional finance for 10 lakhs. 10 lakhs. Total equity, total debt, 10% debt, 16% interest bearing debt, equity shares, retained earnings. Pattern of raising additional finance. The question is answered. Now, second question. Determine the post-tax average cost of additional debt. Additional debt. There are two debts now. One debt is at 10%. We have seen it is 1,80,000. Its face value is 100 and they have given us tax rate of 50%. Just to see, 10% is, we are taking loan number 1, debt number 1, 10%. Earning per share, it is not earning per share, it is face value of debt. We are told it is 1,80,000. We do not know what is its face value. We take it as 100. 10%, 10 divided by 100. Then tax rate is 50%. Post it. Interest into 1 minus tax rate divided by sale price. Sale price we are taking it as 100. 10 into 1 minus 0.5 divided by 100 into 100 is nothing but 10 into 0.5 is 5% in respect of debt. Tax shelter is 50%. Interest into tax shelter itself gives you 5%. Similarly, you can tell us now if 10% is 5%, 16% will be 8% because the formula is the same. If we come here in respect of 16%, the formula is the same. 16 into 1 minus 0.5 divided by 100, you are at 8%. This is a simple formula as such, it is a repeat. Then comes average cost of equity and retained earnings. Once again, we have to be conversant with Gordan's growth model, wherein we saw his formula says D1 divided by P0 plus G, which is nothing but D0 into 1 plus G divided by P0 plus G. This is what is the formula. Now we have to find out what is all given. Earning per share is given as 4 rupees. Then dividend payout is 50%. Current market price per share is 44 and expected growth rate is 10%. We need not have to create G. It is already given as 10%. Then why do we need payout? Payout is to decide how much is dividend. They have given earning. Earning is 4. 50% of it is paid as dividend. Means dividend is 2. We need a D. That's it. Once this is through, it is only a matter of putting the formula. Dividend is 2. Growth is 1 plus 0.10. 10% plus G 10%. And the price is 44. 2 divided by 44 into 1.1 into 100 plus 10%. 2 into 1.1, 2.2, 44 plus 10%, which is nothing but total of this is 5% plus 10%. 15% is the cost of equity and retained earnings both. As simple as that. What is the question that is asked? Let us just see. Determine the post-tax average cost of debt. What we saw was one was at 10%, the other one was 16%, and their weightage was different, 1,80,000 and 1,20,000. And for equity also, we can average cost. We can just see how are we going to do it. We can make a simple statement. We have already come up to this stage. 10 lakhs is spread between these 5. And we have got cost of capital. For equity, we found 15 and 10% was 5. This was 8. What is the amount? Simply multiply the two. 15 into 4. 15%. It has to be multiplied with the weight. 15% into 2,10,000, 5% into 1,80,000, 8% into, and total we get an interest of 1,05,000, 18,600, 1,23,000. On 10 lakh, average cost of capital is 12.36. On 3 lakhs of borrowings, total cost is 18,600. It is 6.2%. On equity, it is the same because 15% is applied, 15%. This statement, when we do, we have answered their questions B and C. Determine the post-tax average cost of additional debt. Average cost is 6.2. Individually, it is 5 and 8. And for equity, it is 15%. And for the company, average cost of capital is 12.36. But in addition to this, he is asking us one more thing. Compute the overall weighted average after tax additional finance. That is already known to us. We are experts in preparing it. We are first posting the value. Then we create the weight. A, B, C, D. Weight is 100%, 49% equity, 21% retained earnings. That means 70%. 18 and 12, 30% is debt. We have got cost of capital, 15, 15, 5 and 8. We multiply the percentage to the weight, 7.35, 3.15, 9 and 0.96. This is what we got when we calculated weighted average cost of capital in the other template under answers B and C also. Now, that brings us to the end of the solution, and these two illustrations, illustrations 15 and 21, we have taken it for the simple reason it is quite innovative in this problem, and at the same time it has given us how to make use of Gordan's model of growth in calculating cost of capital when G is given or when G is equal to B into R, which is where B and R are to be considered to derive at G. It depends on the payout ratio. And with that, we have completed studying Gordan's model. Thank you so much. Thanks a lot.